Yeah.
Let's go.
Let's go.
We're supposed to be starting. I got my dry open. Let's go.
Oh, I know. I got mine too, man. I got mine too. I'm sorry. We're getting into it.
All right.
Easy. Relax, man. Every day's a good day in Nick Pope's life.
That's right.
Yeah. Okay.
Hi, I'm Nick.
I'm Jay.
This is the Nick and Jay Show. Here is our unofficial sponsor, Canada Dry.
Cheers, buddy.
Cheers.
That's good stuff.
That's good.
Today, we are at our newest location by the Covered Bridge in Westmont Rose. This place has mainly been set up as a place for us to shoot some more fun content like this, but Nick's got a hell of a story about it.
Yeah, so this is 5 Covered Bridge. We sold this place. Definitely one of my favorite listings, and I built a relationship with the new owner. And he had this studio sitting around and offered it to us to be able to shoot the Nick and Jay Show. He's a big fan, big fan.
We love that guy. One of the first ideas we had for this space at the Covered Bridge was to have Jordan Schultz from Greater Than Mortgages come in and field some of the questions that we're getting very often about financing real estate this spring and summer. We've seen rates go up quickly, lots of talk about fixed versus variable rates, amortization schedules, and affordability. So here's some of the questions that we threw out to Jordan.
So a common misconception nowadays that I see with many borrowers is that we think that the minimum down payment we need for a purchase price over $1 million is 20%. Unfortunately, this is not the case. Lenders have something we call a sliding scale, which is dependent on the property's location, the purchase price, and then the lender itself. For example, a property valued at $1.5 million, the lender might say that they will allow 20% down payment on the first 1.2 million and then 50% on the remainder. So in this example, if it was 20% on the first 1.2, we'd be looking at $240,000 and then 50% on the remaining 300, which is 150, so a total down payment of $390,000. Compared to 20% on the full 1.5 at 300. So we can see the misconception of what the lender's looking for of the 390,000 versus what the borrower thought. So I'm seeing as of late appraisals coming in a little bit lower than the purchase price. Reason being, people that purchased in late March, early April, end of April, purchasing a little bit higher than sort of the market rate right now. Majority of lenders looking to have appraisals done 30 days prior to closing. So someone who purchased in April is unable to get the appraisal done on the property until 30 days prior. So now as the market has shifted down a little bit, the comparables are lower, which is in result giving the appraisal a little bit lower of a value. So last week, as all of us are well aware, Bank of Canada raised the overnight lending rate by a whole 1% or 100 basis points. If you currently hold a mortgage and you are in a fixed rate, you will not see it will not affect you at all right now until come renewal. If you currently hold a mortgage and you are in a variable rate, you will be immediately affected. Whether you have a true variable or an adjustable variable, you may be affected differently, but I would suggest reaching out to your mortgage agent to see how you will be affected. And for those of you who have a pre-approval to purchase a home that was done prior to July 13th, your affordability will be affected, and I suggest reaching out to your mortgage agent to see where your affordability is now. A true variable rate mortgage is when you have a static payment. As interest rates rise, more of your payment goes towards interest and less towards principal. An adjustable variable rate mortgage is when your payment changes as rate increases, or if rate decreases, your payment will also decrease. What it does as rates increase, as we're seeing right now, so does your payment. This is allowing your amortization to stay on par from the day one of your term. Today is a lot of clients who are on a variable rate mortgage looking to lock into a fixed rate. 9 times out of 10, your lender will give you the option of changing your variable to a fixed. What they do is, if say we're 1 year into our variable rate mortgage, the lender will offer you a 4-year term on the fixed rate they're offering that day. The key to this is not the fixed rate that was offered at the beginning of your term, but rather the 4-year fix they're offering on that day.
Jordan Schultz, everyone. Stick handles around mortgages like he does a puck. Silky smooth. Woo.
Amen, brother.
Well, if you have any questions, message Jordan, message Jay, myself. Stay tuned to next time to see who's in the hot seat.
Until then,
Jordan.
thanks, Jordan.